Thank you for joining our webinar today. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with Checkbook-controlled. Our topic today is last chance for 2024, secure bigger tax savings with a solo 401k. And Brett, who is here with me today, is going to be the one presenting. Brett is a solo 401k and self-directed IRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brett is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Thank you, Brett, for taking the time to present today, and I will let you take it from here.
All right. Thank you, Natalie. Confirming back at you that you can hear me okay?
Yes, sounds good.
Awesome. All right, thanks. Well, yeah, thank you, everybody. We're going to be talking about the solo 401k primarily today. We do also offer a self-directed IRA, so we're going to talk about that very briefly because it is an option to self-direct into non-Wall Street assets, just like a solo 401k is, with some differences, which we will cover. And just a quick disclaimer, Sense Financial is not a fiduciary. We do not provide legal, tax, investment, accounting, or other professional advice. If you need such advice, please seek out a competent professional in that area. First off, why should you listen to us? Well, there's a couple reasons, I think. And we have well over 3,000 clients. Most of our business comes from those clients referring their friends, family, and colleagues to us. In addition to that, we have 5-star reviews on major review websites like Google, Trustpilot, BiggerPockets, and Yelp and elsewhere. So please check us out. And we do encourage that due diligence. And beyond that, we have been in business since about 2010. And so just going on almost 15 years now. Which is very cool. And so we're well past the startup phase, been in business for that long, and happy to have you here today. Our mission is to help clients obtain control and protect their retirement accounts. And so you work hard for your money. We want to come alongside you and work hard for you as well in this capacity of providing a vehicle for you to invest maybe a little bit differently than you have heard in the past or have done in the past. And Proverbs 21:5 says, good planning and hard work lead to prosperity. And so we want to help you plan and help reward your hard work by, as Natalie mentioned in the beginning, affording you the possibility of an earlier retirement than maybe you otherwise would have been able to do. So just to cover what the difference between conventional investing versus self-directed investing. Well, the conventional side kind of stays on the proverbial track, right? You have to get to the bus or train at a specific time, and it has specific pickups and drop-off locations. You have to get off the bus or train and get to your next destination by walking or grabbing an Uber or getting a ride or whatever. It stays on the track. So that's your stocks, bonds, mutual funds, and more recently, ETFs as well. On the self-directed side, we have the off-road vehicle, right? This vehicle can go on the tracks, I suppose. Might be risky if there's a train coming, but it could go over the tracks at the very least. And it could go on the streets, on the highways, off-road, over some rocks or logs or whatever. And so it can kind of go almost wherever it wants, right? And that's the self-directed side. I jokingly call it the wild, wild west because it kind of is. As you'll see in the next slide, you can invest in almost anything you want with some exceptions. But if you stay, within the rules, wear your seatbelt, stop at the red lights, stop at the stop signs, there's almost no limit to what you can do with a self-directed retirement account. Such as, and by the way, these are just some examples. It would be impossible to have an exhaustive list because the IRS doesn't tell you what you can invest in. They merely tell you what you can't invest in, which I'll share later. But suffice it to say, some of the major or more common non-Wall Street investing is residential real estate, commercial real estate, precious metals, cryptocurrency, private lending. Your IRA or 401k can become a bank and lend to just about anybody, with some exception around you and your immediate family, and get a return. And private lending actually is one of the more common ways to invest using your IRA or retirement account because of the passive nature of it and the contractually agreed upon returns that the account is going to get that you can't get in Wall Street, quite frankly. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. Hopefully nothing is coming up. Last one was COVID, which was a little dip in everything. Before that, it was probably 2008, 9, 10, somewhere around there. And people who were invested only in Wall Street saw a big dip for sure. Now, if they kept buying, they got stuff on sale, which was good. If they stopped buying, they missed out on those cheap prices and maybe got in when the market started improving, which is not necessarily what you want to do. But my point is, if you were diversified into assets that were secured by something physical like real estate, as an example, then you probably almost definitely did not see the dip in your retirement savings. In fact, many of our clients did not see that dip inside their 401k and IRA because they were invested in what I just said, in investments secured by real estate. And so the rent money kept coming in and they weren't looking to sell. So even though the house took a hit on a value perspective, it didn't take a hit on the monthly income perspective. So it didn't really matter. And it's, of course, pretty much gone back up to, it's surpassed pre-COVID and COVID numbers for sure. So a quick example, Brad and Jennifer out of Phoenix, Arizona, are real estate agents, and Brad approached us several years ago and discovered the solo 401k. He's self-employed, so they were able to adopt a solo 401k plan, and we set that up for him. And he rolled over some existing retirement accounts, and his goal was also to make contributions from his real estate business. That was quite successful, but he wanted diversification, so he started buying rentals inside of the solo 401k. Multifamily and residential. And actually, he didn't just do this in his solo 401k. He did this in his Roth 401k, because the solo 401k, unlike an IRA, has a Roth component and a traditional pre-tax component built into it. And so his result several years later is millions of dollars inside of his Roth solo 401k. They're already over 59 and a half, so they can take quite literally tax-free ATM withdrawals, which is pretty cool. I always say, if people ask me, should I put money in the Roth or should I put money in the pre-tax? Ultimately, it's up to them, of course, in consultation with their tax advisor. But the more you can put in the Roth, the sooner, the better your retirement's going to be, without a doubt. All right, so what are the options? Well, I already alluded to this. The self-directed IRA and the solo 401k are the two products that we do here at Sense Financial. As you can see from the diagram here, the self-directed IRA is for just about anybody, where the solo 401k is for the solopreneur primarily and their spouse, the business owner and their spouse. And so we'll talk through some of these qualifications further, but essentially, for the solo 401k, you can't have any full-time W-2 employees outside of yourself and a spouse. And again, the self-directed IRA, anybody can do. With the self-directed IRA, however, because the contribution limits are lower, $7,000 for 2024, $8,000 if you are over 50, versus $69,000 or $76,500 if you're over 50 in the solo 401k. Many of our clients, in fact, almost 100% of them that do an IRA, actually roll or transfer in existing retirement account money to be able to self-direct, because it's hard to build it up at $7,000 or $8,000 a year from zero, or even from $10,000. Whereas the solo 401k, because the contribution limits are so high, if your self-employment is robust enough to take advantage of those contribution limits, which I'll explain how they work in a moment, then you can start it out from scratch. You can start it out from zero and just fund the plan from contributions as opposed to a rollover, but you can do both. So first off, let's cover the checkbook IRA. How does that work? By the way, it's called a checkbook IRA for a reason. All of our plans have what's called checkbook control, which allows you to, in the case of the IRA, bypass the custodian. In the case of the solo 401k, eliminate the custodian. And so through the checkbook control, you have check writing authority, decision-making authority. You are the fiduciary. All assets are in the IRA LLC or the solo 401k trust, but you are the manager of the LLC that holds the assets. So you have manager power, and you are the trustee of the trust in the solo 401k. So you have trustee powers, trustee control. You're the fiduciary. Your job is to make money for the plan as quickly and efficiently as you can, and doing it smartly, of course. So here's a diagram of how the checkbook IRA works. First off, when you say you're ready to go, we'll start by processing the order, of course. We'll open a new account with an IRS approved custodian. Once that's done, by the way, this custodian allows for non-Wall Street assets. So this is not Vanguard, Fidelity, T. Rowe Price, Schwab, who you may have already heard of, most likely. You can have money come from one of those custodians into this new custodian that allows for non-Wall Street assets, but we're not going to open one at one of those brokerages. It's going to be an IRS approved custodian that allows alternative assets. And so then from there, a qualified transfer is set up. Now, this transfer, there's one exception for the solo 401k. Otherwise, what I'm about to say applies to both. This transfer can come from any current IRA or 401k or 403b. Now, there is an exception with the 401k. If it's with a current employer, then you're probably going to have to make that a former employer before you can roll it out into another plan. With some exceptions, about 2/3 of employer-sponsored plans, once you're over 50 years old, people don't know this, a lot of people don't know this, will actually allow you to do what's called an in-service rollover. And what that means is in-service means you stay in service, you stay employed there, you don't leave. Rollover means you roll some money over. Typically, they don't allow you to roll matches or profit sharing they gave you over, but they will allow you to roll over your contributions and I believe the earnings on those as well. And so something to ask the plan administrator if you want. Say, hey, does our adoption agreement allow for in-service rollovers? I'm over 50 years old. Can I do that? And just the worst they can say is no. Okay, so that's the thing with the 401k with the current employer. The other thing with the Roth IRA is that's the only one that can't go into a solo 401k, but it can go into a self-directed IRA. So I mentioned this a few slides ago. The IRA is either a Roth self-directed IRA or it's a pre-tax traditional self-directed IRA. It's not both. You can have both or one or the other, but it's not both. The solo 401k has both built into the same plan, which is very cool. Okay, so that transfer is set up. Then the LLC is created. Again, this is single member LLC. Okay, the only member is the IRA. You're the manager. With that manager level power, that manager access, you open bank accounts. You can open, you open a bank account, and then the LLC is funded, which is basically like saying you put the money in the checking account that is in the name of the IRA LLC. Okay, IRA has 100% of those units. So when that money is in that checking account at that point, it's ready to self-direct. And so if you self-direct into real estate or trust deeds or whatever investment you decide to do, the income and the expenses related to that are going into and out of that checking account. And that's how it stays in the IRA and the LLC. Okay. The 401k works a little bit differently. So you have to have a plan sponsor. This is the self-employment activity, right? This is not passive income. This is not you living off of your rental income from single family rentals. That doesn't qualify you. It has to be actively earned business income. And what that means is you're running a business, right? An active business. You're selling something, you're providing a service. Many of our clients are consultants. Many of our clients are real estate agents, investors. If you are living off of rental, rental property income, passive rental property income, Schedule E income, that's fine. Congratulations, by the way, that's amazing. If you're living off of that and you want to do a solo 401k, and I'll share with you why you might want to do this, then you can, if you're self-managing at least one of those rentals, you can set up a property management company very easily as a sole proprietor. And now that business, that sole proprietor property management company, can sponsor the solo 401k plan. So that's how you would make that work. But it's not hard to become self-employed. I'll share some more on the next slide, but a sole proprietor, corporation, LLC, partnership, by the way, non-spousal partnership can sponsor this plan. So once that's established, I qualify for a solo 401k plan. That plan sponsor adopts the plan, and the plan and the trust, the adoption agreement and everything is created. Okay, now you are the trustee, as I mentioned. All the assets are in this solo 401k trust, including the bank account, which you are able to open as the trustee. You can open a brokerage account as well if you want to invest a little bit in Wall Street. Maybe you have some funds sitting in the plan that you don't want just sitting there earning a nominal interest rate inside the checking account. So while you're looking for the right investment, so you can actually open a brokerage account, transfer some of those funds into that brokerage account, do money market, S&P 500, whatever you want to do. And then easily when you find that investment you want to do, you can transfer that money, liquidate it, transfer that money back into the checking account for deployment into that investment. So that's how that works. And then just like the IRA, you're going to, all the income and all the expenses from investments are going to flow back into that home, which is the checking account for the funds. Okay. And so whatever in the investment is, as long as it goes into and out of the 401k trust, then that's what you want to do. Okay. All right. So what are some of the benefits of being self-employed? Well, I said I would dig into this a little bit further. It's not hard to become self-employed. Okay. I could join a network marketing company tomorrow because they'll take anybody, right? And I'm self-employed. If I sell something, I'm going to get a 1099 at the end of the year. By the way, this is activity requirement, not income requirement. Okay. So I can establish this business today, set up a solo 401k today, and not be making any money in that business. It's very flexible. I can get my real estate license tomorrow and set up the solo 401k and not sell a house till 12 months from now. It's okay. It still gives me the ability to roll over existing retirement funds, with the exception of the Roth IRA, into the solo 401k and self-direct it. You can build residual income being self-employed, be your own boss, help people make more money, hopefully. You get, obviously the tax code is written for self-employment with additional deductions, the office, home office, etc., vehicle. And then of course, working from home is great. Nothing wrong with that at all, maybe. And you also get to deduct expenses first and then pay taxes last, which is very cool. So those are some of the benefits of being self-employed. It doesn't take a lot. Some silly examples. By the way, I was talking to a client. Actually, he was a prospective client, not a client yet. This is several weeks ago, and I was talking about the difference between the self-directed IRA and the solo 401k, and I made a joke. I said, he had a full-time job, W-2, 9 to 5. I don't remember what he did, but he was busy. And I said, if you want to go the route of the solo 401k instead of the self-directed IRA, and we had already laid out the differences, so he understood the value over the IRA, you could do something as easy as mow lawns on the weekend. Okay. You're going to report that. It's going to be a Schedule C, tax filing, but you can mow lawns on the weekend. And I was just completely joking, kind of making a silly example of being self-employed. And he said, "Are you serious?" And I said, "Yeah." And he said, "Because I mow lawns on the weekend." And I'm like, "No kidding. You got to be joking with me." He's like, "No, I'm not. I'm dead serious. I literally have like a landscaping business type thing that I do on the weekends." I'm like, okay. So I think there was more to it than just being like a teenager and mowing your neighbor's lawns for a few bucks, but nevertheless, made me laugh. So yeah, you could do that, and it's not hard. Okay. So be self-employed, and then you can take advantage of these high contribution limits, but the contribution limits are taken advantage of by that self-employment income. Okay. So there's a couple ways to fund the 401k or the IRA, and that is through contributions or through rollovers from existing retirement accounts. Okay. So with the solo 401k, unlike the IRA, which is 7,000 or 8,000, solo 401k is 69,000 or 76,500. It's going up, incidentally. I'll share this on a slide here in a few minutes. It's going up a little bit for 2025, which is cool. But you wear two hats being self-employed. You wear the employer hat and you wear the employee hat. And as the employer, IRS allows you to put in as the employee, the IRS allows you to put in a contribution called the elective deferral or employee contribution. This is the same contribution you would have at the W-2 job. Incidentally, this is per person, for all plans. Okay, so you cannot double dip on the employee contribution. So the max for the employee contribution is 23,000 if you're under 50, or 30,500 because it has a 7,500 catch up if you're over 50. Okay, so 23 or 30,500 for all plans. Okay, now you can contribute 100% of what you make. All right, so that's pretty cool. If I am a sole proprietor and my net income is $30,000, let me lower that a little bit. It's like 25,000. I can put in 23. Okay, so you have to adjust for, it has to be your adjusted earned income, but nevertheless, it's almost 100% of what you make. Okay, on the employer side, that's a profit sharing. That's a percentage. So it's roughly 20%, or if you're S Corp doing payroll, it's 25% of the payroll. So it's either 20% of the profit of the company, or it's 25% of the gross W-2 payroll for the year. Simple math, if I make $100,000 as a sole proprietor, filing a Schedule C, net profit, $100,000, I can put in the 23, plus I can put in another $20,000. Okay, so simple math. Again, it's not going to work out exactly like that, but that's rough. Same idea for the 401, for the S Corp filing payroll, doing payroll, $100,000 gross payroll, W-2 for the year, 23,000 done through payroll, by the way. And the profit sharing, not done through payroll, but based off the percentage, 25% of the payroll. So 25,000 plus the 23. Okay. And so Proverbs 21:20 says, the wise man saves for the future, but the foolish man spends whatever he gets. So yes, important to save for the future. Yes, I will spend some time talking about Roth. Let me do that now. So the contributions to the 401k can either be pre-tax or Roth, or a combination of both. The reason you want to do Roth, obviously, is it's after tax, but there's no taxes on the way out. So, the argument is my tax liability, my taxable income, or my tax rate is going to be lower when I retire because I'm no longer working. Maybe. I don't know. I don't really want my tax rate to be lower, because that means I'm possibly making less money. But I think you're taking a little bit of a gamble. I don't know that taxes are going to be less come retirement. I suppose it depends on when your retirement is. But if you're 10, 20, 30, 40 years away, then you're taking a big gamble that taxes are going to be lower. So anyway, or you do pre-tax contributions and you save on taxes today. I think a combination is the way to go. So something that you can do is you can make pre-tax contributions to the 401k, saving taxable income today, reducing your taxable income today. And then you can make an investment, and then you can do a Roth conversion. You can do a Roth conversion on cash inside the plan, but that amount you convert to Roth is going to be added to your taxable income. Okay. So if it's $100,000 that you convert to Roth today, that 100,000 is going to be 1099 to you, and that amount is going to be added to your taxable income for the year. So that may push you up into a different tax bracket. And there's some nasty jumps. There's like I forget, 10 to 16 or 17, and there's like a 22 to 31. So you want to check with your tax advisor to stay under those thresholds, because some of them, it could be like one more dollar of income puts you from 22 to 31. So you want to be under those thresholds. But I digress. Figure that out. We're here in December. You could set this up. You could do a Roth conversion at the end of December, taxable income for 2024. You could do another Roth conversion on January 2nd. taxable income for 2025. So that would be a way to do it kind of simultaneously, but spread out the tax liability. Furthermore, you can convert, which is what I was starting to say, not just the cash inside of a plan to Roth, from pre-tax to Roth, you can convert an asset. And so what really is a powerful method is to convert, let's say it's a trust deed that you invested in, $50,000 trust deed. You go to a third-party valuation company. We have one on our website under recommended vendors, and you pay them to basically appraise this asset, and whatever they appraise it at is the income, the Roth amount, right? That's going to be added to your taxable income for the year. So real life situation, $50,000 principal investment, trust deed, second trust deed, valuation comes in at $21,000. So Roth conversion is done at $21,000, but the payoff is $50,000 plus all the interest. Furthermore, it's actually in default. That's probably why it was such an aggressively discounted value. So if it goes through the foreclosure process, it's going to be like a $300,000 property, or $330,000, give or take. That's all going to be Roth. There is a first, so the investor, the 401k, would have to bring the first current, but they would own this property and get the rental income now, or sell it or whatever. So anyway, just you could do that. It might not be as aggressive as a discount, 60% or whatever that works out to be, from 50 to 21. But typically it's going to be 25 to 35% less than the original principal investment. It's pretty cool. There's lots of case law, by the way. This is completely legit to be able to do. So here's the formula. If you're thinking about it the way I'm thinking about it: pre-tax contribution, save on tax today, make an investment, convert get the value on the investment, the actual asset, and then convert that instead, because it's a way to hack your way to more Roth money and pay less in taxes. Okay, thank you for indulging me on that. Here's the limits for 2025. So the no change in IRA contributions, catch up or regular, under 50 contributions. 401k contribution is going up from 23,000 to 23,500. So $500 jump, nothing wrong with that. And then the 401k catch-up contribution is actually staying the same, with one exception. If you're between 60 and 63, that catch-up goes from 75 to 11,500. So kind of cool. If you're between 60 and 63, you want to take advantage of that. And then you can see that the HSAs have an increase as well there. So, and we don't do HSA accounts, by the way, but that's just something that was also increased. So we wanted to show that. So pretty cool. All right. You can use leverage, by the way, for IRA, 401k, has to be non-recourse. We do have a list of non-recourse lenders on our website, SenseFinancial.com/non-recourse-lenders. And that means the property is the only security for the loan. And so if the 401k or IRA defaults, the property is the only thing the lender's coming after. Because of this, it's a little bit more risky. There's no personal guarantee. You are a disqualified party, so you cannot make a personal guarantee for this loan, for the retirement account. But it's a little more risky because of that. So it requires 30 to 50% down. And the property needs to cash flow. Not a lot, a few $100 a month-ish. And you do have to have some reserves in the plan. And then in the IRA, this will trigger a UDFI tax on the income derived because of the mortgage, something that I'm not going to spend time delving into today, but just know that you have that tax in the IRA and not in the 401k. And then I mentioned the website there, SenseFinancial.com/non-recourse lenders. Disallowed investments. Well, collectibles and life insurance. Actually, there is some way to invest in life insurance in the 401k, but this is not allowed in the IRA at all. Collectibles, think art, NFTs, baseball cards, stamps, cars, that sort of thing. I'm sure someone bought a Bugatti and drove it around and that rule came to be. But anyway, you can't do collectibles or life insurance. And then the other thing that you have to stay away from is investing with disqualified persons. It could be a business that by the way, disqualified persons is defined as your immediate family, a lineal descents. Okay. You, your spouse, Bible says you and your spouse are one. when you get married. So you and your spouse are one, which actually allows you to, and I forgot to mention this, both participate in the solo 401k. So don't let me forget to come back to that. But you, your spouse, your children, their spouses, and your parents and your grandparents, okay, blood descendants, are disqualified. So if any of those people hold a controlling interest in a company, you can't invest in that company. If any of those people none of those people can go stay or benefit from or stay at a rental property that the retirement account owns. Okay, you, your spouse, your children, their spouses, your parents, and your grandparents. You could not buy a property in Arizona and send your daughter to school there in college and have her stay at the rental property that's owned by the retirement account. That would be a prohibited transaction and cause a lot of problems. As a real estate agent, the other thing is none of these people can provide services for the retirement account. So as a real estate agent, I can't represent my 401k or IRA on a transaction. Even if I don't get paid for it, I still can't do it. So you can't provide services and you can't be compensated. So I couldn't do either one. An easy way to think about it is that you can provide you can do white collar work, but not blue collar work. Simply put, I can hire the person that swings the hammer, but I can't swing the hammer myself. I can hire the person and I can choose the color flooring or the type of flooring that goes in the rental property. And I can walk through to make sure it's being done properly, but I can't install it myself. Okay. And so that's white collar versus blue collar. Let's see. Oh, hold on. All right. You know what? Let me go back. Actually, I am so sorry. I forgot to mention a key part here. The 401k is for the business owner and their spouse. I mentioned that, but I forgot to dig into that. Very important. If you and your spouse are part of the same adopting business, you can both participate in the same plan. Okay. So, what I mean by that is, simply put, the benefits double. So it's essentially you're a partnership, one of the spouses is an employee, or you have like a joint venture set up. Consult your tax advisor on the best way to set up your business, by the way. This is not that type of advice, but if you're set up like that in one of those fashions, the benefits double. Both of you can participate in the plan from a rollover perspective of your individual accounts. So you have one umbrella, which is the solo 401k plan, and then you have your separate accounts underneath that. Just like as if you both worked at Walmart and you take part of the same Walmart sponsored solo 401k plan, but you have your separate accounts. Okay, it's the same exact idea. So I wanted to make sure I came back and said that. Thank you for indulging me. Let me fast forward back. Okay, this is just a one pager with the differences between the IRA and the solo 401k. And I did want to talk about one thing on here that I didn't cover at all here in a sec. All three of these, by the way, the difference between the self-directed IRA versus the IRA LLC or solo 401k is that the self-directed IRA does not have checkbook control. I call this a full custodial self-directed IRA. Again, all of our plans have checkbook control, which allows you to either eliminate or bypass the custodian when making investments and doing transactions. If you have the self-directed IRA without checkbook control, you have to go through the custodian for everything. So if you have a rental property, just simply paying a bill has to go through the custodian. All the assets, that rental property is actually, title is held in the name of the custodian for benefit of your IRA, as opposed to the LLC or the solo 401k. And so it just creates red tape, transaction fees, depending on the fee schedule. So you want to just educate yourself and figure out which one is best. We obviously think the checkbook control is best for a lot of reasons, because those are the only ones we provide. But again, custodian required in the IRA, yes, not in the solo 401k. Transaction fees, yes, and not in checkbook control. The personal loan, so this is called a participant loan, which is only available in the solo 401k. So you can borrow up to $50,000 or 50% of the total plan value, whichever is less, and use it for any reason. You may come to me as a client and say, "Hey, I want to buy a rental property, but I want to benefit from it. I want to keep the rental income." Okay, well, you can't do it in the plan because you're a disqualified party. What you can do, and the money has to go back into the plan unless you want to cause a distribution early, or maybe you're over 59 and a half, in which case it would be okay, but that's a taxable event if it's traditional money. Anyhow, you can use the participant loan and buy that rental property. That maybe that $50,000 is enough to make the down payment work and to buy personally. Now, you are paying it back at an interest rate of prime plus 1%. I think prime is now 7.75, so 8.75%, but you're paying your plan back, which you're the beneficiary of anyway at some point. And so that participant loan can come in very handy. People have used it to pay off high interest credit card debt, put a down payment on a primary residence. So the amortization period for everything it's used for except a primary residence is 5 years. If it's primary residence, it's 15, and you pay it back quarterly or monthly. It's up to you. And there's no prepayment penalty. So you can pay it off and do this over again. Some people, actually quite a few of our clients, use this participant loan option to fund fix and flips they do in personally, right? So they can keep the profit from that. And they pay it off well before the 5 years, because when they flip the property and they sell it and they get the profit, they pay off the loan, and then they do it again when they find the next property. And so it's a very advantageous feature that the solo 401k has that the IRA does not. Again, we talked about the UDFI or UBIT tax on leveraged real estate, which the solo 401k is exempt from. Don't misunderstand me. The solo 401k can still have a UBIT, which stands for unrelated business income tax, if you're running an active business inside the plan. Okay, so this doesn't mean that an active business is a prohibited transaction inside the IRA or 401k. It just means that the income is going to be subject to this tax, which scales up to 37%. Okay, so it can be pretty hefty. Now, you can take deductions, depreciation on the portion of the income that's subject to this tax, but it makes it a little bit more complicated. And the 401k and the IRA, the IRA would have a tax return called a 990T that it would need to file for that income. If it's the 401k or IRA and you're running an active business, or it's a general partner in an active business, all the income is subject to that. So it's designed to be invested passively. So this is the IRS's way of leveling the playing field between me personally running a business and having to pay all the taxes associated with it versus you doing it in your IRA or 401k in a tax advantaged environment. So the IRS says, nah, we're not going to allow that. So you have unrelated business income tax on that business income. The max contribution, of course, we covered is 10 times more literally in the solo 401k. And then the solo 401k has the built-in Roth, of course, the self-employment requirement there. So hopefully that helps. Let's see. I did want to offer a free consultation. If anybody wants to jump on my calendar, I promise you are going to walk away with value. It doesn't matter if you become a client or not. It's going to be a good call, I promise you. But no hard sales or anything like that, just education. If you want to jump on, I'm happy to have a conversation. But I'm also happy at this point to answer any questions that either have been submitted along the way or that you have right now. So type them in.
All right, we do have one question so far. Again, as Brett mentioned, if there are additional questions, please take the time to type them in right now. But this question is from John, and he's asking, can you use active income from oil and gas investment to generate funds for 401k?
Well, John, it depends on how you're reporting that income. So I assume you're asking if that business can adopt a 401k plan, and so the income from those can go into the 401k as contributions. I think that's what you're asking. If you're not, correct me, but it depends on how you're reporting it. If you have an active business that you're reporting on a Schedule C, or you're filing a corporate income tax return, and you're working for this money, you're wearing the employer hat and the employee hat, then yeah, that's fine. If you're asking about can the 401k invest in those, then yeah, the 401k can invest in those. Be passive with it. I wouldn't invest in them as like a general partner, but if you can be like a limited partner as an example, then that would be okay and not trigger that UBIT tax. So hopefully that answers your question, John. Thank you for it.
Looks like that is the only question for today's session, but if there are additional questions, please reach out to our office or schedule a consultation with Brett. We'd be happy to help in any way that we can. But thank you for joining us today. Hope you all have a great day.
All right. Thank you, everybody. Thank you, Natalie. Really appreciate it. Take care.